and welcome to slide pack 10 of the financial modeling program. Now, what we plan to talk about in slide pack 10 is some level of detail on the cash flow statement. And there are a lot of line items, but I will not necessarily go into the definition of each one of these. If someone wants more detail, they can always refer to the company's financial statements. And I think that's also a good practice where if you have any doubts, you always can go back to the company's financial data, which is typically available on the website for publicly held companies. So with that, again, what I'm going to do is dive into Excel. And our favorite example, our project example, Cisco Systems. What I have here is the cash flow statement. Again, all of these numbers are in millions except per share data. And this is for the quarter ended the 30th of July. And I think I have a typo there that really should say 2011, which I have changed. Sorry about that. So now the cash flow statement typically has three categories. The first category is operating activities. The second category is investing activities. And the third category is financing activities. So the way every cash flow statement starts out is you basically start out with the net income for the quarter that just concluded or for the fiscal year that just concluded, depending on whether you're calculating cash flows for the quarter or for the fiscal year. So what we have here is net income of $1.9 billion. And that's always the top line. So if you think about the income statement, there's the net income that is at the very bottom of the income statement. With a cash flow statement, all you're trying to do is you're trying to take the net income and then figure out how much of this was a cash expense and how much of this was a non-cash expense that can be added back. So you're trying to gauge the flows of cash in and out of the company for the period that you're looking at, which could be a quarter or which could be a year. And you're trying to sort of say, I started out with a beginning balance of cash. I did a certain number of things through the quarter on the operations front, on the investing front, on the financing front. And now what's the amount of cash I've ended the quarter with? And what you typically, for a healthy company, want to see is a growth in cash over the quarter. Quarter on quarter, you want to see your cash growing. Cash depletion quarter on quarter is not a healthy sign for any business. There are times when it's okay for a company to be in a situation where it's depleting cash, for example, if it's a startup. But at some point in time, that has to turn from a negative cash depletion story to a positive cash generation story, because that's what business is all about. It's about cash generation and it's about profit generation. So let's just go through each of the line items here. The first one says adjustments to reconcile net income to net cash provided by operating activities. So the first line item is depreciation, amortization, and other non-cash items. So what this means, and I'll go into some level of detail on depreciation, but perhaps not in some of the others. Think about depreciation expense. Going back to our car example, if you bought a car for $20,000 and it's now only worth $8,000, and let's just say you're depleting the cost of your car as an expense of $2,000 every year. The fact of the matter is you paid $20,000 upfront to buy that car, and quarter on quarter or year on year, you are not paying an additional $2,000 to anyone as a depreciation expense. But this is something that you're merely recording so that you can reduce your tax burden. So it's a non-cash expense. And because it's a non-cash expense, you've got to add it back to your net income saying, this was not cash that was taken out of the company. Because remember, what we are trying to do here is figure out the impact on real cash. The same applies for something such as amortization. It's a non-cash expense. And what I will do here is I will skip over line items that do not have data in column L. So the next one which has data is share-based compensation related to acquisitions and investments. So let's just say that there was a compensation expense that was incurred and recorded when you were doing your income statement. But in reality, if this compensation was by allocating a certain number of shares to people, that to employees of a company that was being acquired, shares and share certificates were given out, but cash was not given out. So this is again a non-cash expense that must be added back because cash did not leave the company. Provision for doubtful accounts, small amount, -$3 million. And what that negative means is that in this case, yes, indeed, cash was lost by the company because a doubtful account is basically an account that does not pay you money. So it's like a customer who sort of says, let's just say you did business worth 100 million. And he says, look, for whatever reason, I'm only going to pay you 97. So that's a real, and he gives you 97 in cash, and you've recognized income based on the 100. But this is 3 of cash that actually did not come into that into your company. So this is a provision for doubtful accounts where Cisco recognized in this quarter that we are not going to see $3 million that we previously recognized as revenue. So let's take that out because that cash is not cash that we ever are going to see. Provision for inventory, and that is $60 million. Deferred income taxes. Now, deferred income taxes here is real cash that was given out and that ultimately made it as an asset on Cisco's balance sheet. But this was cash that has left the company in this quarter. So there's a -$161. Tax benefits from employee stock option plans. Again, a -$161. And for details, you can actually go through the financials on Cisco statements. In-process research and development. Now, this in-process research and development was an expense that was recognized by Cisco, but it's which is allowed from an accounting rules perspective. And the reason why Cisco recognizes certain such expenses is so it can reduce its tax burden. But this in-process R&D really was not cash that came out of Cisco's pocket. And then this net gains or losses on investments is a -$12. Now, next, they look at change in operating assets and liabilities. So what you see here, in fact, what you've seen in the first part that we've just discussed is how the statement of cash flows ties in very directly with the income statement. So all of this, depreciation, amortization, share-based compensation expense. In fact, your clue here is the word expense. That's an income statement item. Share-based compensation expense, provision for doubtful accounts, etc. So all these deferred income taxes. Income taxes is something that you see as an expense line item on your income statement. So all of these were linkages with the income statement for the statement of cash flow. Next, where they talk about changes in operating assets and liabilities, they are moving away from the income statement to the balance sheet. And I'm just going to scroll this up a little. So the accounts receivable, and it's $34 million. So what this does is it actually tracks the changes in the accounts receivable between the previous quarter and this quarter. And what that difference basically tells you is whether cash came into the company in the quarter from the various clients that had to pay us, or whether cash went away. So what happens in this case is that the accounts receivable balance likely went down, which signifies that clients paid money to Cisco and cash came into the company as a result of a change in the accounts receivable number. And that's always a good thing. Inventories negative 76. What that means is that Cisco had to spend money where they paid for supplies and for various expenses tied to building up their inventory. So even though inventory is an asset, there was a real amount of cash that Cisco had to expend, in this case $76 million in the quarter, towards building up its inventory. And I'll just read the other categories, not go into details. Prepaid expenses. Now, a prepaid expense, again, it's money that you pay out of your pocket. And let's just say I'll give you an example. If you pay out, your car insurance for the next 2 years, it's money that you've paid out and you recognize that as an asset, but it's money that has left your pocket. Lease receivables for the various leases that Cisco Systems has entered into. There's accounts payable, which is 21. Now, what's interesting about the accounts payable is that when this number goes up in the statement of cash flows, what it means is that relative to the prior quarter, Cisco held off a little in this quarter and did not pay out as much. So its accounts payable balance in this quarter is higher than it was in the last quarter, which basically means that Cisco hung on to cash that it's supposed to at some point in time pay out to its suppliers. Income taxes payable. Now again, this is cash that now income tax is recognized as an expense on the income statement, but the tax has not as yet been paid out as of the end of the quarter. It's money that is due, so it's a liability, but because the cash did not leave the company, it's an add back to the statement of cash flows. Accrued compensation, again, it's money that Cisco needs to pay to its employees and its contractors, etc., but it's money that has not as yet been paid out, but it is an expense that has been recognized by the company. So it's cash that has stayed inside the company, and Cisco's recognizing that $59 million is cash that did not go out on that accrued compensation expense line item. Deferred revenue, $226 million, fairly self-explanatory. And then they've got other liabilities, very similar, sort of think about it as accounts payable or any payable that, did not take cash out of the company. So just going back very briefly to deferred revenue, I mean, this is where, the money has come in, but Cisco is on the hook to deliver product or services. So this is money that actually has come in, but has not been recognized as revenue earned by the company. So that's why it's being added back to the income statement. And, quite frankly, a lot of this, to understand and follow along, a lot of this is not very simple. It requires a fairly good understanding of how accounting is done, what accounts receivable is, or what taxes payable are, or what deferred revenue is, and how does that really sort of impact cash. So I know, this is not an accounting class, this is more a financial modeling class, but we wanted to give you a quick overview of what these line items mean so that you can at least think about them or do some more research or Google it or talk to your accountant and figure out exactly why something is increasing or decreasing. And I think if you model a couple of companies in terms of projections, all of this will flow very, very easily. So now, when you add everything up, you get the net cash provided by operating activities. And so what I want to reinforce here is that a lot of what we saw happen in the cash flow statement flowed from the income statement and changes in the balance sheet from the prior quarter. So when you build out your projections, if you've built out your income statement and you've built out your balance sheet, you can use those two projections to build out your statement of cash flows. Now, Cisco, like a lot of other companies, also does a fair amount of investing. So if you look at cash flow from investing, the first line there in row 33 is purchases of investments. What that basically means is that Cisco spent $5.2 billion of its own money and invested it in a host of investments. And the notes to the financial statements will give you the details on what those investments were. But they could have been an investment in a company, a minority stake in a company. It could have been investment in stock of a company. It could be an investment in a certificate of deposit or a bond or whatever. Now, there are certain things that also mature. So, for example, had Cisco invested in a bond that matured, that would have given money back to Cisco. Or if Cisco invested money in a minority stake in a company and that company got acquired, that would have resulted in money back to Cisco. So what you have here in line 34 is proceeds from sales of investments. This is money that came into Cisco's coffers because of the various investments that actually got liquidated. Acquisition of property and equipment, fairly simple, straightforward. $222 million was spent on buying various properties, equipment, computers, testing machines, what have you. Acquisition of businesses. Cisco is a very acquisitive company. They make large acquisitions, but they primarily make very, very small and very smart and very forward-looking acquisitions. So here, what it's telling you is that there was roughly about $300 million that Cisco spent in real hard cash on the various acquisitions that it did within a quarter. Pretty amazing. Within 3 months, these guys spent $300 million in making acquisitions. Change in investments in privately held companies, negative 11. And on this one, I'd refer you to the notes to the financial statements. And then purchase of minority interest of Cisco Systems Japan. So this is probably money that they paid out to their Japanese partners to increase their holding in Cisco Japan. And then there's a other line item of 14. So when you add all of these up, what it says is that the net cash provided by investing activities is $1.7 billion. Had this number been negative, we would have said net cash used in investing activities. Now, cash flow from financing activities. Cisco issued common stock, very likely through what's called a secondary offering of Cisco shares in the open market. So Cisco likely offered $495 million worth of Cisco shares, either on the open market or to a private buyer. You'll have to look into the financials statements notes to figure out who the sale happened to, but basically someone wanted Cisco's stock, which Cisco agreed to sell and got $495 million as cash into the company. Now, every time a company feels that its shares are depressed, it tends to go out into the market and buy back its own stock. And by doing so, the company really is increasing the value of its shareholders' wealth. So Cisco spent $2.5 billion on buying back common stock, and then there's an other category of 51. So when you look at all of this, the net cash used by financing activities, and I say used because it's a negative $2.048 billion, is the money that Cisco had to expend on its various financing activities. Now, when you add up the cash from operating, investing, and financing activities, you get $2.49 billion, which is money that is the sum of everything that Cisco did. And what we have here is, that's sort of an error there, but basically I want you to focus on cash and cash equivalents at the beginning of the period. So when you actually take the changes and you add the cash that you started with, that gives you the cash and cash equivalents at the end of the period. And what I'm going to do here really quick, just to sort of go back to this is let's just go back to an earlier period in Cisco's time. So what happened here in cell C53 is you've got negative $1.4 billion. So in this particular fiscal year, Cisco ended up, I'd say broadly speaking, losing cash to the tune of $1.5 billion. Now at the beginning of the period, it had cash of, this is column C, cash of 4.7 billion. And because it used up 1.5 billion, it ended the period with only 3.297 billion dollars. So fundamentally, to reiterate, you start out with your net income, you add back cash from operating, investing, and financing activities. And if you've generated cash in these three activities, then your cash balance should go up. If you've depleted cash, then logically your cash balance should go down at the end of the quarter or the period. So with that, we conclude our brief summary of the cash flow statement. Thank you very much.